One of the things about being a dividend investor is that we're always on the hunt for the next big discount, and we actually get excited when we see share prices plummeting. Like what we're currently seeing with stocks like Foot Locker, which is down about 26.5% in the last month, or Big Lots, which is down about 10.5% in the same amount of time. And although it may sound counterintuitive, it actually makes sense when you think about the main objective for most dividend investors. Rather than buying stocks hoping the share price will go up, our primary goal is to create recurring cash flow that will grow with each passing year. And when stocks are cheaper, it means we'll be able to purchase more of this cash flow without having to invest as much money. It's just like buying a t-shirt on clearance. It's the same shirt. Today, you're just able to pay less for it. And the same reasoning applies to dividend stocks, which brings me to the topic of today's video. We are going to be getting into Big Lots, Foot Locker, and SBUX, all dividend stocks that are sitting on the clearance rack right now, and ones that we'll try to identify as being either good stocks to own or ones that are better left hung up and out of your portfolio. So that's what we have coming up first, and then later on in this video, we'll get into a little Q&A where I'll answer some of your questions like when you should prioritize dividend growth over dividend yield and how I go about timing the purchase of my stocks. Anyway, before we get rocking and rolling, if you guys are stoked to talk about some dividend stocks that have just been beaten down in share price, go ahead and give this video a big thumbs up. Also, leave me a comment below and let me know which dividend stocks do you think are the best bang for your buck right now. I'd be very curious to hear which discounts you all have your eye on. Anyway, thank you so much for doing that. And now, without further ado, let's get into it. All right, guys, now to kick things off, we are going to be talking about Foot Locker, ticker symbol FL. And as you can see, Foot Locker has just been plummeting. In the last year, it is down 39.62%. In the last 6 months, it is down over 45%, almost 46%. And then in the last 30 days, they are down another about 26.5%. Now, while Foot Locker has been declining for some time now, a lot of these losses really have just come in the last month and are due to some news surrounding Foot Locker's relationship with Nike, which according to sneakernews.com makes up about 55% of Foot Locker's business. Now, apparently Nike has been successfully expanding their direct-to-consumer business, and in doing so is reducing the amount of inventory in retail stores like Foot Locker, sending Foot Locker's share price all the way back to the ground floor. Now, how substantial of an impact this will have on Foot Locker over the long term, I think it's too soon to say, but in the immediate, Foot Locker looks to be at a pretty sweet discount, and as you guys can see on the screen right now, they have an overall valuation grade of an A. Now, getting into some of the valuation metrics, Foot Locker has a forward PE ratio of 6.97, which is great. Single-digit PE ratio indicates some extreme affordability, and this is also about 46% lower than the sector median PE ratio, which is great to see for Foot Locker. Now, moving on, getting into the price to book, forward price to book of 0.94, which is actually pretty unreal, guys. This is 66% lower than the sector median, and a price to book below 1.0 is truly amazing. It means that the current share price is lower than the actual book value of each share of this company. Now, getting into the price to cash flow, this is also looking really good. 6.63% in the single digits, and this is 40% lower than the sector median. So really, all across the board, and as we scroll up, you can see all that green there. All across the board, Foot Locker is looking very nicely valued. Now, going over to the dividend page, getting into some of those stats, guys, there's some things I like about the dividend, and there's some things I don't like about the dividend. Now, starting with the things I like, I really like this forward dividend yield of 5.16%. That's pretty dang high. I also really like the payout ratio of almost 13%, which is very low. So combine a low payout ratio with a high dividend yield. That's pretty nice to me. The low payout ratio indicates that they're not contributing a lot of the free cash flow to this dividend, which hopefully means that the dividend is not financially stressing the company out too much, which hopefully should result in more dividend payments and ideally more dividend growth as time goes on. But as you guys know, that's never guaranteed, and that actually doesn't look to be the case here with Foot Locker, at least not for a long period of time. And this gets into some of the things that I'm not necessarily crazy about with this company. The dividend growth history is only one consecutive year, which ideally I'd like to see more than that. I'd like to see a history of growing dividends, and the 5-year growth rate is very unideal. It's actually negative, where we would normally like to see a 5-year growth rate that's increasing. Now, a high 5-year growth rate would be maybe, in my opinion, like 7 to 8% or above. Guys, this dividend is actually declining, which is never a good thing. And to dive a little bit deeper into this, let's go over to the dividend history page where they give the consistency a D. Zooming in here, we do see a drop off on the dividend. We can see that it went from 40 cents per share on April 15th, 2020 down to 15 cents per share later that year. So there was a dividend reduction, but it does look like they have since brought it back up to that 40 cent per share range. And overall, regarding Foot Locker's dividend, I got to say there's probably more things that I don't like than things that I do. I personally will prioritize the 5-year growth rate and the dividend growth over like a high dividend yield. That's just not as important to me personally. All right, guys, now moving on to stock number 2, we have Big Lots, ticker symbol BIG, who this time last year was actually on quite a run. And in June 2021, you can see was sitting at a share price that is about double where it's at now. It used to be up over $72 per share compared to where it's at now, which is just over $38 per share. And then as far as the share price performance in the last year, they've dropped like 40%, almost 41%. In the last 6 months, they're down almost 23%. In the last 30 days, they're down 10.5%, which is a big drop. Now, before we get into the valuation, I would actually like to talk about the dividend first, guys, and share with you some things I like and some things I don't like. So the forward dividend yield is actually pretty average, 3.25%. I could take it or leave it. Payout ratio, okay, looks pretty good, 20%. This is also very low, like what we saw with Foot Locker. The 5-year growth rate is nice, 7.4%. However, Big Lots doesn't really have a dividend growth history, 0 consecutive years. And if we go over to the dividend history right here, guys, I want to just look and see what these payments have been looking like. And just looking at this chart right here, if we zoom out a little bit more, we can see that it's been pretty flat for the last couple years. It looks like the dividend has been 30 cents per quarter per share since about 2018, so this time 4 years ago now. And I'm actually very curious as to why that is, because the payout ratio is really low, so I wonder maybe why they're not growing the dividend. Maybe there's some financial trouble going on there. And upon doing a deeper dive, guys, when I browsed through their financial statements, some of the things that stuck out to me as financial red flags included pretty stagnant revenue growth, a very substantial debt increase with not a lot of cash or free cash flow coverage, and also very inconsistent free cash flow with some recent years showing negative free cash flow, which has got to be the culprit behind this missing dividend growth. And with that said, we should still go over Big Lots' current valuation because it is pretty dang cheap. And scrolling up, like what we saw with Foot Locker, Seeking Alpha gives it an A. Very nice valuation grade, which is no surprise. It's down quite a bit, across all time periods. And as far as the PE ratio goes, it's sitting at 7.24, which is about 45% lower than the sector median. Scrolling down, taking a look at the forward price to book of exactly 1.0. Very nice price to book. This is 65% lower than the sector median. And then they have a forward price to cash flow that's also extremely low. Seeking Alpha gives it an A+, 3.37 for the forward price to cash flow, which is 70% lower than the sector median. So really all across the board, across all valuation metrics, Big Lots looks to be in a great spot. And with that said, guys, although the valuation does look strong, I would highly implore you guys to take a deeper dive into Big Lots, take a look at the financials. And while we're on the subject, this also applies to the other stocks we're talking about in today's video, as well as any other stocks we're going to be covering in future videos, guys. Don't just take my brief surface level analysis of these companies at face value. Back it up for yourselves and see what makes sense for your own portfolios. All right, guys, now moving on to the third and final stock I wanted to talk about today. That is one of my favorites, Starbucks, ticker symbol SBUX. I actually, while we're on the subject, have a little bit of the bucks right in here. Anyway, as far as this company's share price performance, in the last year, they're down nearly 14%. In the last 6 months now, they're down about 22%, so pretty big drop in the last 6 months. In the last 30 days, they're down another 4.6%. So across all those time periods, Starbucks is in the red. And from what I can tell, guys, a lot of this poor performance is coming as a result of COVID-related costs and pressure from inflation. And because of this, shouldn't have too much of an effect on the company over the long term, which means I am buying more. Truthfully, though, I am pretty biased towards Starbucks and keep it as one of the larger positions in my portfolio. It actually used to be one of my top performing stocks and was up over $110 per share back in November, but now I'm getting fairly deep in the red, so I plan to pick up some more shares and lower my average cost while I can. With that said, though, I still think Starbucks has ways to come down before it is really at any sort of discernible discount. And taking a look at the valuation, guys, we can see this to be true. Seeking Alpha gives it an overall valuation grade of a D, which is not great. Okay, and they have a forward PE ratio of 27.39. And then going down, they don't have any sort of forward price to book measured, so we'll skip that. But the forward price to cash flow, guys, is also not great, 20.53, which is 89% higher than the sector median price to cash flow. Now, getting into this company's dividend, guys, just like with the other two, there's some things I like, there's some things I don't like. And Starbucks has a little bit lower of a starting yield, 2.14%. Moving on to the payout ratio, it's 56.12%, which is not too bad. I'm kind of neutral about it, okay? And then the 5-year growth rate is one of the things that I really enjoy about this company's dividend. Currently sitting at 15.87%, which is a huge growth rate, and in my opinion, makes up for the lowish average dividend yield. Now, getting into the last metric, the dividend growth history, they have 11 years of consecutive dividend growth, and I want to see how long they've been paying the dividend. So 11 years of growth and also 11 years of consecutive payments. So every year they've been paying the dividend, they've also been growing it as well. And just look at that. Look how steep that growth slope is for the dividend, guys. It's unreal. And just some quick closing thoughts on all of these stocks, guys. Now, the first two, Foot Locker and Big Lots, obviously were at very nice valuations. Definitely look to be at pretty nice discounts right now. Starbucks, yeah, although it's come down in share price, down 13% in the last year, 21% in the last 6 months. To me, guys, Starbucks still has a lot more room to continue coming down in share price. And the only reason I've been picking up some shares lately is because I'm currently in the red. I have an opportunity right now to lower my average cost per share. And if you guys are in a similar situation, I don't think it's a bad idea to buy more shares. But as far as starting a new position in Starbucks, I'd keep an eye on it and see what it continues to do. I mean, if it keeps coming down in share price, sure, that's going to present a buying opportunity. But right now, I would just keep your eye on it unless you have an opportunity to lower your average cost per share, in which case I would say definitely do that. All right, guys, now moving on and getting into the Q&A segment of this video. Our first question is coming from Georgia Lee, hope I pronounced that right, who is in the Discord and says, okay, apologies in advance as the answer is probably extremely simple and self-explanatory, but why target a stock with a high 5-year dividend growth rate, per se Starbucks, over a company with a potentially lower 5-year dividend growth rate but has a higher dividend yield, so is still growing but not by as much? So basically what they're asking is, why would you prioritize dividend growth over a higher dividend yield? And I think it really depends on where you're at in your investing journey. If you're someone like me who is younger, has decades and decades left to invest, you have a lot of time to let those dividends grow over time. And in that instance, it might make more sense to opt for a higher dividend growth stock versus a higher dividend yield stock. But all in all, I do think it's important to have a balance. And just speaking personally, I've got some stocks in my portfolio like EPD, ORCC, Altria Group, which have really high dividend yields. And I also have some other ones like Starbucks or Snap-on that offer more in terms of dividend growth. So I do think it's important to have a balance between the two. Now, hopefully that answers your question and makes sense. I really appreciate you asking. And now moving on to the second question of the day, which comes from Mr. Leah Paranoid, who says, thank you for the great video. When investing, do you do so in a particular period, like say before the ex-dividend to receive the payment, or after the ex-dividend when it is cheaper? Or do you just invest in what you think is undervalued during this time? That's a really great question. And I've had a couple of people bring this up to me, like their strategy is to buy stocks before the ex-dividend date and then like sell them after, or something weird like that. And I'll be honest, I don't pay attention to any of that stuff. I don't know when the ex-dividend date is for any of my stocks. I honestly don't even know the payout date for a lot of my companies. I just kind of let the dividends come in and do their thing. Really what I'm concerned about is choosing good companies and buying them on a regular basis. Now, there is one thing that you touched on at the end of that question, investing in what I think is undervalued during this time. That's probably the best way to describe how I go about buying stocks. And to explain a little bit further, in my portfolio, I currently have 22 different stocks, but I'm not contributing to all 22 of those right now. On any given week, I'm choosing 2 or 3 different dividend stocks that I think are looking undervalued within my portfolio, and those are the ones that I'm contributing to. So in my case right now, that's Snap-on. I've been buying Snap-on every single week to try and build out that position, and that stock is coming down over time, which is nice. I've been buying Intel, which has been at a discount for some time now. I've been buying 3M, which, as I'm sure a lot of you know, is very cheap. So thank you so much for that question, and if any of you guys out there have any questions on dividend stocks you'd like me to answer, drop them in the comments below. I'm doing this Q&A segment every single week, so I'm always answering your guys' questions when I can. And with that said, I will now get out of your hair. But if you enjoyed learning about some cheap dividend stocks today, then let's keep this party going, okay? Check out these 2 videos on the screen right now for more dividend stock content, and consider subscribing to the channel if you want to keep in touch and see more videos from me in the future. Anyway, thank you so much for watching. I hope you guys have a great day, and I will see you in the next one.